I think, I think we'll get started here. If everybody could grab a seat. How is the sound? Is that all right? Is that too loud? I feel loud. Oh. I'm not used to this. I feel like an air traffic controller, so I'm just getting used to it. First of all, thank you and welcome on behalf of myself, Bill Giffen, and the rest of Trust Company of Illinois. I was just told earlier, I think by Brandy, this is our 10th event that we've had, and I know, I've had the opportunity to participate in 2 of them. I think it's always a great day to have the opportunity to spend some time together through conversations like this and then individually after. So thanks for taking the time. And before I forget, where's Paula? Paula is the reason this happened, and I want to thank her. For all the hard work that she's put into this and all the detail that goes into it. So Paula, thanks. We've got a pretty packed agenda. I'm excited about it. We have Rick Mattoon from the Federal Reserve Bank of Chicago. We're also going to be doing a webcast of Rick's presentation. We have Jill DeBerdinis from Vanguard, and also John Vyers, our Chief Investment Officer, is going to spend some time on investments and planning. So we're excited about the day, and then we'll have a chance after for either some questions and also some questions at the reception. The one thing I am excited about also to speak briefly on is our new logo. As you've noticed, you've probably seen some different colors up here than maybe you have typically in the past. We're excited about rolling this out today. It's the first time really being seen. We're excited about the future of this organization and where we're going. And we thought maybe after 23 years, we'd update our logo a little bit. So as you start to see new envelopes with different colors on them, don't throw them away. That's us. Or brochures with this logo on it. So we'll start to see that happen over the next couple months, 2 to 3 months or so. The other thing I want to mention is a little different alignment of the chairs at NIU if you've been here in the past. Typically, we're facing this way. We're looking at TV screen. I wanted to try to bring you in a little closer, and I wanted to create a little bit more intimacy in regards to the conversation that we're having. And so we labeled it TCI Talks, but for those of you who have ever had the opportunity to watch TED Talks, that's kind of the theme of this and what we wanted to create. And for those who haven't heard of TED Talks started back in 1984 out in California, and it started as a way for individuals that were in the technology industry, the entertainment industry, or the design industry to come to California and speak about their expertise. And so over the next however many years, flash forward to today, these conferences are held globally. They're seen globally through the internet, and I believe in the last couple years they've reached over 1 billion views online. And they talk on everything from religion to economics, math, science, philosophy, politics, whatever it may be. And I think 60 Minutes actually just did something on them a couple weeks ago if you had a chance to see it then. So that was the goal and the theme of this with TED Talks. The other thing with TED Talks that I always like, in many instances, when the presenter's up there, typically for 15 to 20 minutes, there's always something personal that is intertwined within the message that they're giving. And so wealth management many times can be considered somewhat sterile. What I'd like to try to do before I introduce Rick and spend the next 5 to 7 minutes on is personalizing a little bit and kind of what we feel and how we think about wealth management. And so with that, how do you get any more personal than taking you right to my kitchen table? So this is my table at home in Glen Ellen. Does not look that good. And I'm noticing from those pictures, so we actually had a 130-pound chocolate lab that spent about 3 hours on this in the middle of the night devouring my daughter's Halloween candy. And I could see all the scratches in there, and it was quite a scene when we came the next morning, and my daughter wasn't too happy. But there's a lot of nicks and scratches in there. And the quick story behind this is we bought this table about 15 years ago when my wife, Margaret, and I lived in the city. And we were at this place, and the individual who owned the shop was telling a story about how he spends about 3 or 4 months a year traveling around the world looking for wood to either design furniture or tables. And so this wood on the table, on the top of this table, is from a Siberian farmhouse that he had then imported back into Chicago and built all these tabletops, and then built the stands below. And so, as I say that, though, how do I know? Right? This could be from Home Depot, and wood they didn't want. But I stick with the Siberian farmhouse story, and that's what he told us. And so that's the tabletop that we're dealing with. Now, the importance of this for us, and here's where I'm kind of going with the personalization of it, is this is kind of the center of our house. This is where we want to spend all of our time. And what I mean by that is when our kids are doing their homework, I'd rather have them at the table rather than up in their room. We have all of our meals there when we have friends over. So this is kind of a number one location for our house, and it's important for us. And we've actually, as we've rehabbed houses or built a house, we've built it around this 10-foot table because it's important for us to kind of share stories. And I think of all the stories we've had over the last 15 years, and a ton of fun. You know, our kids sitting around the table. We have a daughter that's a junior and twins, boy-girl twins. And we sit around and we laugh, we tell stories, we ask them questions. What do you want to be when you grow up? Where do you want to live? If you go anywhere on vacation, where would it be? Also, decent amount of arguments, fights, debates, typically between the kids, not Margaret and I, hopefully. But just good, fun, good conversations that built kind of family dynamic and built good friendships. But along with that, and this is kind of where I'm going with this, is a lot of serious conversations over really the last 15 to 16 years. And I think of, in 2008, I've got a good friend of mine who's a small business owner, sitting across the table from me really trying to figure out, where does he go next? Or sitting across the table from my wife and my brother-in-law talking about my mother-in-law, their mother, in the early onset of dementia, and how are we going to care for her? And what does that look like out 5, 7 years, and then eventually, unfortunately, passed away a couple years ago? Or I have had family and friends sitting down talking about divorces that they were going through and how that affected their family, how it affected their finances. Or a friend who bought his business from his father-in-law, and what did that look like? Or somebody who sold their business. I had a friend of mine down the street, sold his business, and the money that he came into, kind of that sudden money syndrome. And so how I connect all that, sitting at this table, this is over a span of, 15 years or so, all of these conversations. And I think about Trust Company of Illinois, and all of those conversations could happen within a month, and maybe sometimes within a week, with the advisors that we have, and sitting down and speaking with our clients, going through planned and unplanned events that they may have within their family. And it makes me proud to see how hard these individuals work and really kind of take the personal element of what wealth management stands for and really bridge it to the technical element of what wealth management stands for, that being the investment part of it and the planning part of it, which that's what we'll spend some of the rest of this time on, is really more the technical side of that. But really, through all of those stories that I'm mentioning, it's all about transition points. It's where money changes what it really means to that individual or to that family or to that friend. And even if you look at the statistics, you'll find that one of the statistics I saw was 70% of new advisor hires happen at some transition point, like I just described, some major life event, some point where you really think about money differently. And I also saw a statistic that said 70% of either widows or divorcees fire their advisor within a year because of those changes. So that's interesting to me because I think many times we think of wealth management strictly by a number, but it's so personal. And quite honestly, it's where we start a lot of our conversations. And so I wanted to kind of draw in the table just to meet that and really what money means in the conversations that we have. Now, the second story, now I've taken it to my kitchen table, now I'm taking it on the golf course for you golfers. And what this is and I want to just kind of strike home what really money means. And this is a story of my father. This is my dad on the left. This is me on the right. And two things real quick as I look at this. First of all, I think it's hilarious that my dad's got a Coca-Cola bottle within striking range, that he cannot be away from a soda for more than a minute. And it's in the picture. So the picture is sponsored by Coca-Cola. The second thing, and now this is what just kills me, is I look at my hair. And I had a flowing mane of hair. And this is only 7 years ago. So I have no idea what the next 7 years bring, but it's not going to be pretty for my scalp. But let me walk you through kind of real quickly the history of my father. So my father started out and was drafted by the Minnesota Twins out of college and played AAA minor league ball for the Twins for a couple years. And then he was traded to the Yankees. After he was traded to the Yankees, I had been born. He decided he needed to take a different career track, and so he became a teacher. And he invested, the rest of his life in really the next generation. And he spent 37 years teaching in the same classroom, advanced science, at the high school that myself and my three sisters went to. My mom stayed at home. So really, throughout my life, money was really never spoken about. It wasn't something that we talked about in our family. But there was one moment that I remember. I was a freshman in high school, and my dad's at the table. I'm sitting at the table. He's reading the paper. And he says, Bill, if there was one thing that money could do for me, is I would love to be able to take you to Pebble Beach and spend a day golfing. And so at the time, right, I'm a freshman. I'm thinking about myself, just kind of move on. I was like, that's interesting, And so as I moved forward in my life and I got involved in this business, I thought, you know what, that's interesting. To him, the meaning of that money was time that he got to spend with his family and his friends. That's what was important to him at that point in time in his life. So flash forward to this picture. In 2007, my father retired. My gift to him was, let's spend a couple days out at Pebble Beach. We played Pebble Beach. We played Spyglass. Great trip. We still talk about it today. Anytime he's watching golf on television, he sees Pebble Beach, he calls me. He's like, what a great trip that was. It was enjoyable. We had fun. And so again, at this point in time, what money meant to him was spending time with me. But flash forward another 2007 through 2014, 2015, there were a lot of events that happened for him and for myself. Some planned, some unplanned, that involved money, that involved a transition point. There was a point, actually, this was a couple years ago, and not to get too personal here, but he had an artery burst in his head. We didn't know if he was going to make it. It's a miracle. He did. He's fine. He completely recovered. But it was, okay, how are we going to take care of my mom? She's in her 60s. But these are all of the transition points that we go through every day at TCI. Wealth management to us is personal. We spend a lot of time on that side of it. And it's something that we think about every day. And we want to be, and we strive to be, your confidant, your partner, when you're going through those planned events, but even more importantly, those unplanned events. Because these individuals that are sitting at these desks and sitting at these tables across from you have experienced many of those issues alongside other clients of ours. So it's important to us, and I just wanted to kind of hopefully resonate that a little bit in regards to the personal side of wealth management for us. Last point for you golfers, because I know I'll get this question after. This is hole 11 at Pebble Beach with the fog coming in. My dad and I both hit a great drive. And I don't see where the golf balls are, so I'm thinking we maybe already took the second shot. But I didn't remember what happened next, and so I had to call my dad. And so I called him. I said, hey, Dad, I'm using this picture in a meeting that we're having. What happened? Hole 11, second shot. And so for some of you golfers, you know those golfers that know every shot they've ever taken and every shot that somebody else has taken alongside of them. And so he knew. And I don't know if it's the truth or not, but he says his ball landed on the front of the green. You see that cliff? You know where I'm going with this? My ball ended over the cliff. I don't know if that's the case or not, but I'm gonna believe him. So with that, I want to now move into more of the technical side of this in the economy, in planning, and how we see advisors work with clients, with some of our keynote speakers. But first of all, we are webcasting this today, and I see that from a standpoint of time, the individuals that are looking at this streaming live are just joining us. So thanks for coming. We welcome you. My name's Bill Giffen. I'm with Trust Company of Illinois. And right now, we're going to have Rick Mattoon from the Federal Reserve Bank of Chicago join us. Rick is a senior economist and economic advisor for the Federal Reserve Bank of Chicago. He's focusing on issues that the Midwest deals with from an economy standpoint, and also, obviously, Illinois. He was, for a while, also the policy advisor to the governor of Washington. He has a BA from Kenyon College, an MA from the University of Chicago, and also serves as a lecturer at the Kellogg School of Management at Northwestern. Rick, thanks for joining us today. Thanks a lot.
Thanks very much, Bill.
Thank you.
I really appreciate it.
Yeah.
Thanks very much, Bill. It's a real pleasure to be here. I'm not nearly as entertaining as Bill was, so I'd rather have him come up here and talk for the next half hour, 45 minutes than have me talk. I don't have any pictures of my family, so that's a little disappointing. And I also like the idea of the TED Talks concept, because I think that the only small glitch I see in this TED Talks concept is it helps to have somebody who's actually interesting give the TED Talk. I'm not, so it probably doesn't work quite as well in this environment. I always like to start any presentation I do with a joke, and the reason why is because, unfortunately for most of you, this is going to be the high point of my presentation. So this is actually my favorite economist joke, and it goes like this. A woman goes to her doctor. Doctor comes out and says, I have some very bad news for you. And she says, well, what is it? He says, well, you only have 6 months to live. And she goes, well, doctor, what should I do about this? And he says, I have 2 pieces of advice. Marry an economist and move to North Dakota. And she says, well, doctor, will this help me live longer? He says, no, but it will make your last 6 months feel like an eternity. That being said, economist presentations are often like that. I say I'm going to talk for 30 minutes. It's going to feel a whole lot longer than that for many of you. So I'll apologize in advance for that. So what do I want to do today? Well, first of all, I want to talk broadly about where we think we are in terms of the nature of this very fitful economic recovery that the U.S. has been going through. And then I want to turn to sort of like how Illinois fits within that context. So how has Illinois' economy performed? And are there any sort of special issues that make us maybe a bit more nervous about Illinois' progress at this particular point in time. So the first thing I want to do is talk about some sort of broad themes to think about that we sort of identified so far for 2015. The first thing is 2014 seemed like a much better year for U.S. economic performance. If you took out the sort of the very bad negative first quarter we had 2 really strong quarters in the second and third quarters with 4.6 and 5% growth. And while there was some give back in the fourth quarter to only a 2.2% level, the idea was that we felt the economy was starting to reach a faster acceleration. Not fast as we'll see by historic standards, but faster than we've seen for some period of time. And the expectation was we were going to run into 2015 pretty much with a pretty good bet that we'd get at least 3% GDP growth going into 2015. And since then, we hit the first quarter. First quarter growth was negligible at 0.2%. The expectation right now is that's actually going to be revised down. It probably will have actually been a negative quarter at this point if you look at the data that's coming in. And there was a lot of reasons for economists. I mean, we're always good at coming up with reasons for why forecasts don't work out. But essentially, there's sort of 2 camps that we looked at. The first were transitory things, which was, again, we had another really bad winter, particularly on the East Coast. So that really disrupted a lot of things. And then surprisingly also, the West Coast port strike also had a real effect on supply chains and some of the manufacturing. And it's actually taken almost a full 3 months for that to actually sort of wind itself out. So those were sort of the transitory things. But then there's also a couple of sort of longer term issues that the economy is coming to grapple with. And the first of this really has been the rise in the strength of the US dollar. What you looked at for a lot of companies that were getting a lot of their profit growth out of export operations, that basically slid away. I mean, they have a real headwind right now in a stronger dollar and being able to operate in export markets. And it's obviously making it easier for you to bring imported goods into the U.S. So our balance of trade has actually worsened fairly significantly recently. The other thing was energy. The decline in gasoline prices would seem like a great thing for consumers, and it is. I mean, it translates basically to about savings of $500 to $700 over the year for a household. But this was an industry that really was driving a lot of economic growth on the margin. And so when you started to see these rig counts drop, significant layoffs in the oil patch, and all these other sorts of things, it created a bit of a drag in the first quarter as we were going through this adjustment to having this sort of less energy intensity in terms of investments. And then the other thing that's really been bothersome has been this very choppy consumer behavior. And this I'm going to be really honest about. Economists are completely befuddled by this. Consumer confidence surveys have been running at very, very high levels. Consumers are indicating great confidence both about their current condition and the future. What they're not doing is spending at this point. So one of the problems is what we're seeing is a great deal of reluctance. And one of the things that we all felt was going to happen was as soon as you had this drop in gasoline prices, people would run out to spend the savings they were doing. And instead what they're doing is they're saving it. So there's still a nervousness about where they think the future is headed at this point because they're not translating these savings or this increased disposable income into actual purchases. We still think that's coming at this point, but we also thought it was going to happen the first quarter. Now we're pushing it more into the second quarter, and so there's a little bit of nervousness about that. So what were the good news things last year? Well, first, the headline numbers was a significant improvement in the labor market. We had 3 million net new jobs. We're basically at a run rate right now where we're adding about 220,000 net new jobs to the U.S. economy every month at this point. This was the best performance we've had since 1999. And we've brought down the unemployment rate at a really pretty staggering rate, really to a point where we're almost at what we consider almost full employment for the U.S. economy at this point. So that's been really good. The other thing is stock prices have continued to be really strong. And what you've seen is asset prices. If you own equities, your wealth has been more than restored over this cycle. U.S. household wealth is at a record high. We're at $83 trillion in U.S. household wealth. The problem is if you don't own equities and you don't own assets that have appreciated over this period of time, you're not any better off at this point. So if you're looking for wage increases or salary increases, those haven't materialized. And so for a lot of people, they don't feel any better because they haven't seen that restoration. And if your only significant asset is your house, you also haven't seen that restored at this point. So there's sort of this sense of like some people are doing pretty well, but also a lot of the economy is not doing nearly as well. So that's a problem. Another theme has been relative U.S. strength compared to world weakness. And this has gotten marked down a little bit, but if you still look at U.S. economic growth for this year, it's still going to be significantly stronger than either Europe or not as strong, obviously, as China, but China's in this sort of decelerating mode at this point. So the idea is when you look at where you're going to get world demand at this point, there aren't a lot of markets that right now are really hot. So it's hard for companies to figure out where you're going to expand your sort of sales opportunities outside of the U.S. market at this point. So that's going to be an issue going forward. And then the last point I turn to is something which, economists, we like to refer to this because we think it makes it sound cool, but it's asynchronous monetary policy. And so what you're seeing right now is if you look at 17 of the central banks throughout the world, they either are loosening monetary policy right now or they're actively entering into quantitative easing. We at the Fed have gone in the opposite direction. What we've indicated is our clear goal is to tighten over the not necessarily immediate future, but over some period of time and to normalize Fed policy. And so normalization in this case really means we think that the Fed funds rate should be somewhere around 3.5% to 4%, and we're obviously currently at 0 to 0.25. So that's a significant move up, and the ramp on which we're going to move to sort of get to that level is going to be a significant change. But this is in a backdrop where everybody else is either cutting rates or actively going into quantitative easing. I mean, several central banks through the world at this point actually have negative interest rates at this point to be able to, in an effort to try to spark their economies. So let's turn to some of the evidence. Okay, so the first thing was employment gain was big last year. As you can see, the sort of slope of the line was very dramatic. We're above the pre-recession level level in terms of employment in the United States. So we're above where we were before we got into this recession in terms of jobs in the U.S. But the big problem is if you look at this, we didn't have any gain really in wages and benefits. So if you look at the one shaded bar, the thickest shaded bar, that was this recession. And if you look at wage and benefit costs coming out of this, they basically hovered around 1% throughout this period of recovery. So workers who are only living on wage and benefits at this point haven't really seen any improvement in their condition. In many cases, they're actually worse off than they were before the recession occurred. And so this has had a significant effect in sort of the drag on the economy. We do think this year that you will see a lift in more meaningful wage and salary benefits this year, and we think in the long run that's actually going to be a good news story for the U.S. economy. The other thing that's really different this time around is sort of the business cycle recovery pattern, all right? So what I've done here is I've shown you the two previous most severe recessions in the U.S. contrasted to the current one and the path out from the bottom of those recessions. So the top line is the 81-82 recession, which was both triggered by oil. It was also triggered by significant adjustments in manufacturing. And when you look at that recession, we came out at almost a 5% growth rate coming out of that recession. Very sharp. And this is more traditional what most economists expect. It's what they refer to as a rubber band effect. The more severe the contraction, usually the faster the bounce back coming out. And so you almost came out too hot out of that particular recession. If you look at the 74-75 recession, we came out at a 4.3% rate. So again, very strong recovery coming out. People felt noticeably better about things from the bottom of the recession. But this recession, we're only coming out at about a 2.3% rate. So very sluggish growth, and there's a lot of reasons for that. One is this recession was a financial recession, and financial recessions are just really different from a manufacturing or sort of a more traditional demand-driven recession. And what they really are marked by is a buildup of leverage within the financial system. And until you sort of flush that leverage out of the system, it's very hard to get sort of sustained growth or growth at a faster pace. The good news at this point is we think a lot of the leverage has been worked out of the system, and that we're now better poised to get sort of a faster rate of growth coming out. But the reality is it takes a long time to work that financial leverage out, and it really took the U.S. economy pretty much 5 years to be able to sort of rebalance things. I mean, essentially you can think of it as a sort of a balance sheet exercise. You know, whether you were a homeowner, a government, or a business, you all went through a process of having to rebuild your balance sheet over this period of time, and that's just a very difficult exercise to do. So there's also a lot of other positive indicators we think right now that are happening in the economy. Again, one, consumer confidence, again, continues to run at almost the highest rate since 2008. And as I said, that's a little bit befuddled us as to why consumers aren't spending more if they feel that's good about their conditions. And what you see in terms of that is you are seeing pockets of areas where consumers are showing sort of resilience. Restaurant sales are up significantly. If you look at like the last consumer report that came out, particularly good is that sort of the fast casual restaurants, kind of the Olive Gardens and those things which had been hurt pretty badly during this recession are now doing quite well again. And that's an indication that regular people feel good enough that they're going to go out and spend money on dining. The other thing that's been consistent throughout this period of time is people have been rushing out to buy cars. So, you know, cars right now are running pretty much at almost a 17 million annual clip in the U.S. And the average price point for a car bought today in the United States is about $32,000. So people are spending a lot on purchasing this. And you don't go out and buy a car unless you feel, again, fairly confident about your situation. So they are spending money on these sort of bulky things. The other thing we're seeing is increased spending in home improvements again. It's hard to get a contractor nowadays to do some sort of work on your house. And again, that's another indicator that people are having sort of more fundamental confidence. One thing that we think is slowing but has been a good news story throughout this recovery is manufacturing, and that's really benefited the Midwest region. So manufacturing has been strong throughout this period of time. You've actually seen some indications of some sort of reshoring of jobs actually moving back to the U.S. as lower energy prices have made manufacturers more competitive. And you're seeing manufacturing actually, again, having a sort of a much more important role in the U.S. economy. The problem is the manufacturing cycle right now is really sort of long in the tooth. It's been sort of, came out faster than much of the rest of the economy. And right now it's been decelerating. And it seems to be particularly buffeted by the high dollar. So when we talk to companies like Caterpillar and Deere, they're pretty aggressively marketing marking down what they think their sales are because, again, they don't think they can get the sales that they used to get in their foreign markets. So that's different. And then housing. Housing's been really fitful, and for a lot of reasons coming out of this. The most recent Case-Shiller Index, which is a composite index of 10 major cities and 20 major cities, measures the year-over-year price change in housing. And what they showed is in the last report, housing's up about 4.6 to 5%, depending on which of the indexes you're looking at in terms of prices year over year, which is good, but it's not terribly robust. And what you're looking at this point is you still have national prices that basically are off about 17% where they were from the peak. So in most markets in the U.S., housing hasn't recovered from where it was before it went into decline. So there's still lots of room to be made up. And demand in housing also is spotty because for a lot of people, they can't qualify for mortgages. So people who would like to be in the housing market, given very favorable interest rates, are having a hard time getting in, and that's obviously stifling some of the sort of normal rebound you'd expect coming out of this kind of a recession. So housing's been, it hasn't subtracting anything from growth at this point, but it's not robustly adding anything to growth. So what do we think you should watch for in 2015? Well, the first is do wage gains become meaningful? As the labor market tightens, as we get closer and closer to this full employment, you should see significant lift in wages going forward. And I think we think this will have a significant beneficial effect for retail sales because, again, people who have not seen any recovery over this period of time will start spending more if they see their paychecks grow. Again, if you have anecdotal evidence at this point, 21 states raised the minimum wage in January. You've had, Walmart and plenty of other large retailers at this point raising wages for everyone across the board. So there's a sense in which that's starting to catch up some. International developments, again, you have this sort of, where are you going to get demand from? So, Japan basically has been in and out of recession really for the last 2 decades. And every time they sort of have a little bit of growth, they sort of fall back. And so you're not getting a lot of strength there. Europe, the forecast for all of 2015 is for the entire Eurozone to only grow by about 1.3%. Within that, really only the UK and Germany are really the only, semi-strong markets within the Eurozone. And there's still lots of financial issues to work out within that area, so it's going to be hard for it to sort of recover at a faster pace. And then there's China. So China has reported that their official growth rate has slowed to 7%. This is an economy that's been growing at better than 10% a year for 3 decades. So for them, 7% growth is significantly slower than what they're used to, and managing the path out of that's going to be very difficult. Also, lots of private economists actually think growth in China is actually significantly below the 7% level, so they suggest that it's actually overstating where they are right at this point. And then a couple of other themes I think we'd like to see happen. One is infrastructure spending and construction spending. There's 2 things, again, that have frustrated economists just given what financial conditions are, is that we're not using this sort of historically favorable environment for taking on long-term debt to support infrastructure improvements at this point. State and local governments actually sort of cut back on their infrastructure throughout this period of time. They're never going to have a better environment in which to take on this debt and issue bonds to be able to sort of fund this sort of useful long-term investments, and we're not seeing a lot of that. And similarly in companies, when you look at CapEx, at this point, we really haven't seen a real lift in terms of construction. The way companies are sort of becoming successful is either through stock buybacks, dividend increases, and other sorts of things, but not really growing the business as much. And so this is an idea, again, that this would be the time to sort of take on some additional debt given these incredibly favorable interest rate environment. Another issue is going to be, again, this continuing strength in the U.S. dollar. I've talked enough about that. And then cash hoarding, all right? So one of the other issues we see out there is companies are hoarding cash at this point. So non-financial companies are estimated right now to have probably about $4 trillion of cash on their books. This is money that essentially is earning nothing for them. Banks have about $2 trillion parked at the Federal Reserve in excess reserve. Similarly, this is money that's essentially earning nothing at this point. And we'd like to see that cash sort of start to come off of balance sheets. We think that'd be beneficial. So what's the current forecast? Well, the last FOMC meeting that we announced, the official forecast, was the March meeting. And at that time, there were a couple of things that were significant. The first is we marked down expectations for growth for both 2015 and 2016. So we now expect GDP growth to run at between 2.3 and 2.7% over both years. The hope is we'll be closer to the 2.7 part of that, and that would be slightly faster than where we think potential growth is for the U.S. economy right now, which is in the 2 to 2.3% range. But it's not going to be fast enough that people are going to feel robustly better about their circumstances. So it's modest growth at best. The other thing that was significant that occurred at this meeting is we significantly marked down our inflation forecast for this year. So we prefer the PCE indicator as our preferred measure of inflation, and we marked it down to seeing only 0.6 to 0.8% growth for this year. Our target is 2%, and we think the U.S. economy operates most efficiently when we have 2% inflation. So underachieving on the inflation target is a significant drag on the U.S. economy. We'd like to see inflation start to drift up, and to date, it's been very hard to sort of get that. In fact, the producer price index came out today and actually was down. It's been down for the year at this point. It's actually negative. So we're getting very little inflation in the economy. Unemployment continuing to get better, 5 to 5.2%. Again, close to where we think the long run rate is for the U.S. economy. And this all translated into, in this particular, the March FOMC meeting, is we removed the word patient from the FOMC statement. And this was supposed to be a clear indicator to market participants that the Fed, if data supports it, is ready to start moving up interest rates. But this will be a data-driven decision, and so far the data has been very choppy and sort of not cooperating in terms of making it obvious as to when you make this first rate move. But again, our bias is clearly that we want to sort of normalize rates over the longer term, and that's where we're hoping to go. So that's sort of where our bias is at this point. So let's turn to Illinois. So how did Illinois do in all of this? Well, the first thing, the good news part, okay? Illinois actually started to get some acceleration going into the second half of last year, all right? We saw a significant pickup, particularly in the business and professional services economy in Illinois, and that's really key to Chicago, all right? So, Metro Chicago is basically the state's economy. It's 72% of the state's economy. And so if Metro Chicago is underperforming, all of Illinois underperforms. So we saw this lift towards the end of last year, and you're seeing lots of indicators in Chicago. It's a very tight hotel market. There's significant new construction underway at this point. Tourism is way up for the area. We've started to see, sort of lots of market improvement that suggests that we're sort of on a better path. However, Illinois has fallen into this pattern of underperforming both coming into recessions and coming out of recessions at this point. So the irony is we basically track almost entirely with the U.S. economy, all right? So if you look at sort of like, if you were going to draw both what our economy looks like and how it performs, it almost, mirrors the U.S. economy. The problem is it mirrors it at a lower level. So, we fall harder in recessions and we come out slower. And so that's a challenge for Illinois going forward, because it's going to be a real problem. And again, the unemployment rate by the end of last year in the U.S. almost got to the U.S. level. It's still elevated at 6%, but what you're looking at this point is it was actually the fastest dropping unemployment rate in the United States. So actually the correction last year was pretty impressive. Okay, so here's some, casual evidence of improving economic conditions, and what you should see here is simply in the January to February job numbers. Illinois actually grew somewhat faster than the U.S. as a whole and faster than the rest of the Midwest. But if you look at over the 12-month period, the Illinois growth rate is significantly slower than either the U.S. or the Midwest or Midwest counterparts. But again, we're optimistic that we think we sort of have hit some significant improvement going forward. If you look at industries within Illinois, and this is based on the University of Illinois Institute for Government and Public Affairs. The fastest growing over the last year has been, again, business and professional services, really good. These are high-wage jobs, very much dominated by Chicago. Construction coming back pretty strong after having been down for a long time, and education and health. Declining, again, manufacturing, the effect of the dollar. This is probably going to continue to decline over the next year. And information, the information IT sector seems to be going through a lot of sort of contraction and sort of rationalization, and it's actually had a tough time for some period of time. And what's what's really different this time around has been finance. So normally banking would be contributing a lot coming out of a recession at this point, particularly in the cycle. But because of regulatory changes, because of a whole lot of different reasons, you've seen the banking sector essentially either add no new jobs or actually sort of subtract jobs over this period of time. So we haven't really seen much job growth in banking, which again tends to be a fairly significant employer both in Chicago and Illinois. So however, what could possibly rain on this sort of, somewhat happy parade, all right? So Moody's, which obviously has gotten a lot of coverage in the last couple of days, had this quote when they were assessing the Illinois economy, and it just says, Illinois' economy has improved over the last year, but progress has been slow, and the state has underperformed the region and the nation in key gauges such as jobs, income, and output. The weakness can be traced to failed fiscal policy, a slow housing upturn, and stalled manufacturing industry downstate. I'm going to argue that probably the biggest factor is Illinois' fiscal policy, and it's probably the biggest challenge that the state has in terms of sort of its, sort of near-term and maybe mid-term performance. So the first thing I want to show you is just sort of the path that Illinois has taken coming out of this recession and compared to a state that was actually harder hit. So it's hard to tell. The red line is the U.S. economy, and this is just a coincident indicator. So the way to think of this is sort of like, how far did you fall, relatively speaking, going into the recession, and what's been your path out? What's your sort of growth? And this is all sort of, normed against a scale of 100. And so what you can see is the blue line is Illinois. So Illinois does not fall as far as the green line, which is Michigan, all right? So Michigan was really slammed in this recession. But as you can see, Michigan has actually been growing out at a much faster pace and is actually growing faster now than Illinois. And this is a state that has lots and lots of challenges, where Illinois has essentially maintained this sort of gap with the U.S. We haven't really made up any sort of ground over this period of time, and you'd like to see Illinois sort of closing with the U.S., and we haven't experienced that at this point. So the longer-term issues for Illinois are, what are our problems? Well, first are obviously fiscal problems, all right? So we have the worst-funded pension system in the United States at this point. There's also something called OPEB, which is other post-employment benefits, which is essentially retiree health care. We have nothing put aside for retiree health care at this point. So if you put all these liabilities in addition to a state that already has probably a structural budget deficit of about $6 billion in its general fund, it sort of just layers on additional sort of magnitude of problems. Again, we have this slower long-run growth trend at this point, and our demographics aren't really favorable. Chicago is the only area of the state that added population recently. The rest of the state is actually losing population. And we also have a real challenge because we're getting net out migration at this point. So last year, 63,000 people on net left Illinois, and they're leaving for Indiana, Texas, Florida, California, Wisconsin, Missouri. And we also have an aging population. And one of the real keys for us is, where do the boomers go when they retire, right? So if they stay in the state, that can help Illinois a lot. If they decide that they've had enough and they're out of Illinois, that's going to be a significant problem for the state because they're going to be a significant revenue source moving forward in terms of their behavior. Strengths for Illinois. Okay, so what's going to balance off these sort of fiscal hardships? Well, first is, again, our industry base. We have a really diversified industry base that's really enviable. We're also arguably, with Chicago, the only world-class city in the Midwest. So if you want to serve this market, you have to be in Chicago. It's simply not an option to be in Indianapolis and actually effectively serve the Midwest. So, we've got those sorts of strengths. And we're building new industries also that have a lot of advantages right now. So technology, if you go to Chicago now and you go to the River North area, it's very much of a big tech hub at this point. We're building out sort of new industries that, again, attract a lot of highly educated young people, which is really important in terms of our future growth. We have incredible strength in logistics and distribution. If I showed you the infrastructure sort of map of the U.S., which you would see is more train traffic goes through Chicago than any other city in the United States by a significant factor. And so we have much more ability to sort of move product than any other place in the country. So logistics has become a really important area. Again, strong in tourism and conventions at this point. Higher education and agriculture, we have real strengths in at this point. So those are all great things. And the way this translates is, for most economists who study fundamental dynamics of economic growth is they'll say the best predictor of economic growth is the percentage of your population that has a bachelor's degree or higher. And if you look at Illinois, we have that, okay? So we're better than the Midwest average for the most part, and Chicago is significantly above the Midwest. And that's going to put us in a better position for growth because simply in today's economy, smart people are really sort of, where you get your sort of bang for the buck in terms of economic growth. And we have a superior market position for raising capital and access to the market. So those things are all real strengths to us. So, so again, let's go back to this fiscal issue for Illinois. So what are sort of the dimensions of this sort of fiscal challenge that Illinois faces? Well, the first is unpaid bills, all right? One of the ways Illinois balances its budgets is it simply doesn't pay its vendors. And so if you're a school board or if you're a state university or you're a provider of any service to the state of Illinois, they basically just, pretty much decide when they want to pay you, and that can be 6, 8 months, 10 months out. And so that's sort of like bad behavior simply is a way that allows them to manage their cash, but it's obviously very bad practice in terms of behavior. Off-balance sheet liabilities, so pensions and OPEB. So Illinois' unfunded pension liability is about $110 billion at this point. That works out to almost $25,000 per person for the state of Illinois, and there's really no state that really sort of approaches us in terms of how underfunded our pensions are at this point. And as the Supreme Court decision proved last week, apparently this is not something that can be modified in any way, shape, or form. So the interpretation coming out of the Supreme Court case was that essentially we're on the hook for the entire liability. You can't discharge it through any sort of negotiation with a labor union or with anything else. You have to come up with a way to pay for it. So that's going to be a real challenge. This year we rolled back the income tax rate increase, which was, I think most people were happy about. The problem is that created a $4 billion hole in the state budget in terms of revenues, and we have no new revenue actually to fill that. So it's pressured us even more in terms of that. And you really can't make this up through budget cuts. I mean, if you cut the entire state budget 20% across the board, you still wouldn't get there in terms of the ability to do it. So that's going to also make it much more difficult for what the sort of path of adjustment. So what can the state do? Well, cut the budget. Well, that clearly is going to happen. It's just a matter of what magnitude of cut are we going to actually see going forward. Shift costs onto local governments. I think this is one of the more pernicious things that's going to happen, and it's going to happen in a significant way. So what you're going to have is more and more things that either the state provided in transfers to local governments they aren't going to do going forward. Or the other thing that's going to happen is they're simply going to transfer certain responsibilities to local government. So you'll have to pick up additional costs that you did not pick up previously on the local government. And this is obviously going to pressure property tax bases throughout the region if this is the one way you go forward. As I said, we tried to do pension reform. Good idea. Unfortunately, it's unconstitutional. So pension reform doesn't seem to be an option. The only thing that can happen is possibly pass a change to the Illinois Constitution. And it's not even clear if you change the Illinois Constitution that you can do anything retroactively to the people who were covered before. So it really wouldn't have really any binding effect because there already is a second-tier pension system in effect for all new hires in the state of Illinois that is significantly less generous than anything that people in the first tier were receiving. So that doesn't really provide you much help. So then the last thing comes is obviously revenue enhancement. So what can you do on the revenue side? Well, one is you can expand sales to personal services. Lots of states do this. It's never really popular, but there's actually economic arguments for saying that there's some fairness components depending on which services you pick. Just to give you an example, Iowa, the state obviously immediately to our west, taxes about 119 services. We tax about 17 in Illinois. So it's possible to expand that. Another, which I'm sure is going to go over real popular in this room, is tax retirement income. This is like the third rail of Illinois politics. But Illinois is one of the few states that does not have income tax for any retiree income. And even Michigan, with a Republican governor, actually instituted a tax cap tax, which is after the first $50,000, the state income tax kicks in. And given the demographics of Illinois, you could actually raise fairly significant money by taxing retiree income. The issue would be, of course, would people actually leave the state? And so that would be the one sort of, fly in the ointment to that particular approach. So in summary, I think what we're looking at is a U.S. economy this year that's going to feel a lot like it did last year, which is going to be, it's going to be better. You're going to see improvements both in terms of sort of the way people are feeling. You'll probably see better wages coming out of the economy this year, and I think you'll see things that are sort of improving along the lines. The problem is it's still not going to be that sort of robust kind of takeoff, liftoff kind of thing that people have been looking for, that's sort of like, have we reached escape velocity, some people refer to it as. And I don't think we're, it's not going to feel like we've reached escape velocity, even if we are continuing to sort of grow. As I said, for Illinois within this context, I think you've had this sort of momentum in the underlying economy, sort of the organic economy, but it's going to bump up against this uncertainty in fiscal conditions. And the way I always describe it to people is one of the things that at least business people always say is the thing they hate most is uncertainty, because they can plan against a target, but they can't plan against the unknown. And so right now, if you were talking to a business person, you'd have to say to them, it's like, well, I can't tell you what your tax rate's going to be, and I can't tell you what public services are going to be provided. But I know it's going to be different, right? And so, without any sort of a certain path, that makes it very, very difficult going forward. So these big issues are really going to be fiscal in terms of behavior. So with that, thank you for your time and attention, and I don't know if we have time for questions, or so. Yeah.
Thank you, Rick.
Thanks.
My name is Brandy Harrington. I'm the Director of Wealth Management here at TCI, and I'm going to facilitate some questions and answers for Rick. So we have about 10 minutes, and I'm going to ask, Catherine's going to help me with a microphone out there. So if you have a question, please raise your hand. She'll come to you. We're going to ask you to stand up and state your question, and then Rick will be able to answer it for you. So any questions right off the bat?
While that's happening, I can tell you one more economist joke. So, this is my other favorite economist joke, which is always remember a person that becomes an economist when they realize they don't have quite enough personality to be either an accountant or an actuary.
Okay, question in the back.
A lot of these states have these pension difficulties.
Yes.
And is there anybody that's worked through them, resolved them, come to some day of reckoning with regard to them?
I mean, each state's different. I mean, Illinois is unusual because we have this constitutional guarantee. I mean, there's not as many states that actually put their pension protections in the state constitution, and that limits. So in other states, you're able to negotiate a new deal with a union going forward once you have this kind of liability. So that's a problem. One of the things that has been proposed actually by the governor and some localities actually pushing is a solution that was similar to what Detroit went through, which is to allow Illinois municipalities to declare bankruptcy. They can't right now. And if you did, the idea is under bankruptcy, federal law will supersede state law, and you can possibly break the contracts at that point. But that's obviously a pretty extreme way to get out of this. And the interesting thing was in Detroit's case, that occurred. Michigan also has a constitutional guarantee on pensions. And the federal judge did say they could break it, but they didn't really actually end up saving that much off of the renegotiated pension. That wasn't the major part of the bankruptcy.
Any other questions for Rick?
You said there were 17 services in Illinois and 100 and some in Iowa. What are some examples of other ones that Illinois doesn't do? I'm just curious.
I mean, the ones that, okay, so, I'll give you the economist answer because, it's like we're not tethered to the real world. But so the economist answer would be that the services that often are things where there's a direct competitor for goods production, right? So if I have a lawn service, I don't pay any sales tax on having the lawn service cut my lawn. But if I go out and buy a lawnmower, I pay sales tax on buying the lawnmower. So the idea is that's a situation where if the service you should pay the sales tax on the service. And in other cases, you have services where, frankly, you just can't do them outside the state. So barber shops are often frequently targeted in these because the idea is I'm not going to go to Wisconsin to get my hair cut simply if there's a sales tax on having my hair cut. So the idea is in some of these cases you can sort of rationalize the provision. And the reality today is roughly about, if you look at what we consume as a society, I mean, roughly about 65% of it is actually services today. The goods production part of what we actually purchase isn't that large anymore.
Any other questions? Got one over here. And I'm going to ask one while Catherine's making her way over there. It's with regard to the unemployment rate.
Sure.
And I know a lot of people are skeptical that rate really has come down so much. So I just wonder if you could speak to that.
Yeah, it's a great question. If you look at it, there's several dynamics. So there's obviously several unemployment rates that people look at, and what you're seeing today is that while the official headline unemployment rate has come down significantly, you still have significant underemployment at this point, and people who are working part-time for not by choice. So you're not seeing the kind of growth in sort of the quality jobs that people would like. So the U6, the other unemployment rate that people get, has stayed significantly elevated for this part of a recovery. So again, it's this notion that we haven't gotten the quality of job recovery we'd like even as the unemployment rate has dropped. So it is a little of a misrepresentation to say that we're at full employment when there's such a large percentage of the population that's kind of underemployed still in the market. So,
Thank you.
John.
Rick, could you comment on the downgrade of the City of Chicago bonds? And as part of that, one of the gentlemen I heard on the radio say that one of the big problems is they're downgrading them because there's no plan.
Right. Yeah, the interesting thing is Moody's. Yeah, I mean Moody's said that part of their downgrading was as a lack of confidence in any sort of management plan going forward to actually sort of address the liability going forward. The biggest problem that happens is that the downgrading triggers roughly about $2.2 billion in payments that Chicago theoretically will have to make almost immediately because the bond covenants have been violated in many of these people holding it as soon as this was rated as junk. I think image-wise is a big problem for Chicago. I mean, we're the only junk-rated city now in the United States. Clearly, that's not something you want to be. And then I think the other issue is obviously it's going to translate almost immediately into higher, borrowing costs for the city, and it just gives you less flexibility. Now, in defending Chicago, some of the people who looked at this, who were sort of bond counsels and all, said some of the issue is that Chicago just doesn't have the same guarantees for repayment to bondholders. They don't preference them that some other cities have. So there's cities that are actually in worse fiscal condition, but they simply either create an intercept or a lien on revenues so that bondholders are paid first. Chicago doesn't tend to do that, and so therefore, theoretically, their bonds are riskier because they don't have the same guaranteed repayment streams. So it's not necessarily an indictment that Chicago is the worst managed, fiscally most irresponsible city in the United States. Not necessarily, right. That has to be proven at this point. But it's more an issue of that it's the combination of the structure, the way bonds are handled in Chicago, and the fact that they also feel that there is no ability, that the only people who can solve the problem is Chicago itself, because there is no expectation that the state of Illinois will be able to provide any assistance to the city of Chicago going forward. And if anything, will actually reduce whatever aid they're giving Chicago.
Okay, we have time for one more question.
Okay.
Yeah, I was wondering if you could comment on the effect of rising higher education costs and student loan debts as a drain on the economy.
Yeah, it's a great question. It's a real concern. I mean, higher student loan debt now is more than car debt in the United States, and it obviously, for many people, it becomes a crushing burden in terms of their ability then to enter into sort of normal adulthood. I mean, one of the things was why we're seeing this sort of slow recovery in housing is because lots of young people are paying so much in terms of their student loan debt, they can't enter the housing market. I mean, they have this huge debt overhang moving forward. The issues is sort of how do you address it going forward. One is I think you need to sort of restructure how we finance education from the person's perspective. I mean, the repayment schedule should be much, much longer over a longer period of time. There's lots of other places where the repayments are also income contingent, so the size of the repayment fluctuates with what people's incomes are over time. And so there's ways in which you could rationalize the payment going out. But the other issue, I think, which a lot of people worry about is also transparency in terms of what does the student actually get for the education. And this has happened in the for-profit college area where, again, you've had lots of people who've taken on lots and lots of debt, only to have the for-college profit either fold or actually not actually provide them with the education that they thought they were going to gain. And so therefore they end up with a lot of debt, not really the skills that they thought they were going to get, and an inability, and then really are saddled going forward. So it's a very good question, and it's a real issue. I mean, it's a real issue. So. Okay.
Well, Rick will be around at the conclusion. If you have more questions for him, you can seek him out over a cocktail.
Great.
Thank you
Thanks,
very
Brandon.
much, Rick. Thank you.
So it's so great to have a partner like Vanguard. You know, one of the great things about being a manager of managers like we are at TCI is that we get exposed to a lot of different thought leadership from outside firms. We don't have to be smart. We can surround ourselves with smart people. And Vanguard does a ton of research, a lot on behavioral finance, which I think is a really fascinating subject. And they do a lot on practice management, which is really important for us as advisors. It teaches us how to be better investment advisors for you, to be better wealth managers for you. And we've incorporated a lot of what they've taught us, a lot of the research that they've done, into how we invest. It's really kind of driven our philosophy of lowering internal expense ratios in our portfolios. But beyond that, they've taught us how to better communicate to our clients. And that's an area that we're really trying to improve on. They did a white paper, Vanguard did a white paper. There are copies out there afterwards if you feel like you want to read up on this a little bit more. Between desired return and required return. Desired return is a lot of times what we want, required is what we need. And I think some of the differences between these two types of returns, desired and required, is number one, desired return is emotionally driven. Many times it's driven by fear in a bear market that we're losing money, or fear of regret in a bull market that we're not getting the kind of returns that we would like. Very emotionally driven. I think required returns instead are plan driven. This is a chart that probably many of you have seen. It's a Monte Carlo simulation. We use this in all our financial plans. And what we do is we enter all of our clients' goals into the software. And whether it's a second home, retirement spending, travel, leaving a legacy for kids and grandkids, whatever it is, we put those spending goals into the plan, and then we take a look at the portfolio that fits best for them, and we come up with a probability of success. I like this expression because probability of success is pretty understandable. And so we're looking for a probability of success in the 85% or better range. A lot of times we'll sit down with clients who desire a higher rate of return. And the way to do that is to add more risk into the portfolio. So we plug in a portfolio that does have higher expected returns, but also more risk. And so a lot of the plans, when we do that, will actually end up showing a lower probability of success. There is a downside risk to doing that type of thing. You ought to stick to the plan that makes most sense for your financial plan. Desired return, focused on getting ahead. I had a phrase offered to me recently that there's a class of investors who are looking to step on the gas. That may be what they desire, doesn't necessarily mean that the market's going to cooperate with that. Instead, we think investors ought to stick to staying on track. This is a chart you've probably seen a few times from us in the past too. This illustrates from the top of the market in 07 to the very bottom in 09. And you could look at that number at the bottom for the S&P 500, down about 41% annualized, 50% in total. To recover from a 50% decline, an investor needs a 100% gain to get back from a 50% decline. For a lot of people, that episode in the Great Credit Crisis resulted in a permanent loss of capital. We're trying to avoid that. We want to stay on track for your plan. Desired returns focus a lot on relative returns. Everybody has benchmarks. It's part of the industry. What are you going to do? Relative returns relative to the S&P 500, to the Barclays aggregate, to what your neighbor did or a guy in the same country club. Required returns focus on risk-adjusted returns. Risk-adjusted returns are important Here I have two different portfolios illustrated, both with the same average return, 8%. Same average return. The portfolio on the left, however, has more volatility, more ups and downs. And so at the end of the day, it ends up with a cumulative return of 31%. Same average return with more consistent returns on the right results in a cumulative return of 36%. More dollars in the portfolio because of more consistent returns. Desired returns results in yield chasing. I don't know how many people here remember auction rate preferreds. This became very famous during the Great Credit Crisis. A lot of institutions had invested in these as a substitute for cash. Liquidity was really cheap and prevalent and available. And so institutional investors wanted the higher yield that was available in auction rate preferreds because they were just like cash until the credit crisis came and they weren't just like cash. The bid process dried up and these institutions were stuck with an illiquid asset. That's yield chasing. Instead, we think you ought to exercise discipline and patience. I show this chart every year just to see if anybody can possibly read it. Nobody possibly can. And I show it one thing, as Jill said, to show you that investment returns are random from year to year. They are. There's no way we're going to figure it out. The other thing is to show you that they do kind of go in cycles. You could see in the early 2000s at the top, that real dark blue asset classes, emerging market stocks. For a long time, they were the hero of our portfolio. And for about the last 5 years, they've been the GOAT. These things go in cycles, but they'll come back to you eventually. All it requires is a little bit of discipline and patience. You cannot draw a straight line, linear extrapolation from what's happened in the past 7 years, except for Giffen's hairline. That is exactly straight line. So you got to exercise a little bit of discipline as far as that's concerned. Now, we do make changes to our investment process. I get the comment from time to time that valuations are really high, the outlook's pretty poor, you sound like a broken record, and well, in that sense we are. But just because we're trying to stick to a discipline doesn't mean that we're not out exploring different options and different abilities to improve our process for our clients. Number one, we invested in software run by a company called Tamarack that's helping us more tax efficiently allocate our clients' assets between their taxable accounts, their traditional IRAs, and their Roth IRAs. Research that Vanguard's done says that can add up to about 60 basis points or 0.6% of after-tax returns for clients. We made that investment to try to get better after-tax returns for our clients. We've lowered our internal expense ratios. Jill mentioned how important that was. We've taken them down about 50% over the last 5 years, and they're only going in one direction from here, and that's down even further. Master limited partnerships as an asset class. I don't know how many people are familiar with them. They're new to our portfolios. They represent the midstream energy space, pipelines. So you're not really tied in as tightly to commodity prices like oil. It's more about supply and demand. And these pipelines, with the booming domestic oil production, have become a great growth story in the U.S. economy. Additionally, the contracts to move that oil have inflation kickers. So they're really tied in to the rate of inflation. It's a great hedge against rising prices. Finally, offers further diversification to our portfolios. Lastly, private equity. Now, private equity offers what's called an illiquidity premium. It's not for everybody. It's for accredited investors. It's for people who can tie up 5 or 6 or 8% of their portfolio for a long period of time. But what private equity offers those investors is returns above what the more liquid public markets will provide due to that very illiquidity. All right, so we'll open it up for any questions that you might have for me or for Jill. I know cocktail hour is getting very close here. It's usually... All right, well, okay, I'm going to have Bill come back up and close out the conference.
Well, first, I do want to thank Rick. I want to thank Jill, and I want to thank John. And especially Rick. for taking the time. I know you get a lot of requests to spend time in front of audiences, and I thought that was some great insight, and obviously very timely in regards to what we're going to, specifically in the state of Illinois. So thanks for your time. And Jill, thank you also for your time. And again, I think it's great, as John mentioned, especially through Vanguard, they get the opportunity to work with thousands of advisors across the country, and to get some of their insight and what they see is incredibly helpful. So thank you. What I will do, because I know we're coming up on 5 o'clock, and one of the things that the TED Talk does very well is they start on time and they end on time. And so I want to make sure that we do that. So if there are any other last questions, I'm more than happy to answer them. And also, we are all going to be around, and so please, I love to have the opportunity to spend some time with each and every one of you, and if you have any questions, I'll be outside, but more than happy also to answer any in the group if there are any. No? Okay, well, true to TED Talk form, we will end on time. Again, thank you for your trust. Thank you for your confidence with Trust Company of Illinois. We are extremely excited about the future and where we're going with this organization. And again, we look forward to partnering with you as we move forward. So thank you so much.